Backbone of the stock price. Google, the biggest targeted advertising company financial statement. Starting off with balance sheet. We are checking 7 metrics. Out of the 7, we got 5 metrics with good score. So, let's look under the hood at the financial health. And honestly, it is a fortress. You look at the cash versus the debt. They're swimming in cash. They don't need to borrow money. They don't need banks. They fund themselves with their own equity. It is extremely safe, basically bulletproof. But, you see, it is not all perfect. There are cracks. Take the share buybacks. Historically, they haven't done it. The average is 0. That is a negative signal. It means they sat on the cash instead of returning it to shareholders. And then, there is efficiency. How hard are they working that money? On their assets? It looks great. They use what they have well. But the return on equity? It is a bit soft. It missed the benchmark. It's not terrible. But for a giant like this, we expect it to be higher. So, safe? Yes. Efficient? Mostly. But shareholder-friendly? Ideally, we want to see more. Next is income statement. We're checking 9 metrics. Out of the 9, we got 8 metrics with good score. So, let's dig into the margins. And honestly, it is impressive. They have pricing power. Real power. They charge a premium. And people pay it. Every time. And you know what? They don't have to push hard. The product basically sells itself. They aren't burning cash on marketing just to keep the lights on. Even the research costs. The R&D is surprisingly low. They are innovating, but they're doing it efficiently. It's a simple business at its core. Now, let's talk about debt. There isn't any. Well, practically none. The interest payments are 0. If they wanted to pay off all their loans, they could do it in months, not years. It is incredible safety. But there's one little snag. The taxes. They are paying a bit less than usual, less than the standard rate. It looks good on paper today, but it worries me. It invites scrutiny. Regulators might come knocking. However, when you look at the bottom line, the pure profit is huge, over 20%. That is a massive competitive advantage. They are growing faster than inflation, making more money per share, year after year. It is a machine. Next is cash flow statement. We're checking 6 metrics. Out of the 6, only 2 metrics got good score. So, let's talk about the shares and the employees. Are they printing too many new shares just to pay bonuses? No, they are disciplined. They are keeping the share count tight. You aren't getting diluted. That is a good start. But here is the red flag. The earnings quality. On paper, the profits look huge. But the actual cash, the money hitting the bank, it is lagging behind. The cash flow is lower than the profit. That is worrying. We usually want it the other way around. And you have to ask, why? Where is the money going? It is the spending. The capital expenditure. It is massive. For every dollar of profit, they're spending half of it on equipment, on data centers, on chips. It is a high-cost game. They are burning cash to build the future. Profits are growing, but cash flow is struggling to keep up. So, what happens to the cash that is left? They give it back, almost all of it, through buybacks. They aren't hoarding it. They are rewarding you. The shareholder is sustainable, but they are clearly prioritizing growth and spending big to get it. The combined financial score is good, 15 metrics with good scoring out of 22 metrics. Knowing just the financial statement is not enough. You can find the rest of the analysis on Google, the biggest targeted advertising company, in my channel.